When most of us make our trading decisions, we're staring at the same thing, the stock chart. It's what everyone sees. But what if I told you there's a hidden layer of data, a whole other story that professionals are watching? Well, today, we're going to pull back the curtain and see what they see. Let's dig in.
Right, so you pull up a price chart. It shows you exactly what happened in the past, right, to the penny. But does it really tell you where the price is going next? Or, more importantly, why it might be going there? It gives you clues for sure, but it's kind of like reading a book with half the pages ripped out.
Think about it this way. Just using price action is like watching a movie in black and white. Yeah, you can follow the plot, you know who the characters are, but you miss all the nuance, the mood, the richness. The pros, they've figured out how to see the market in full, vivid color. And they do it by tapping into a whole other data set.
And that extra layer? It's options data. This is where things get really interesting. See, price action is all about the past. It shows us what has already happened. But options data? That's about the future. It shows us what the market thinks might happen. It's the difference between knowing the what and understanding the why. It's how they decode what the market is really thinking. Okay, so how do we actually start reading the market's mind? It's not as complicated as it sounds. It really boils down to 3 key metrics that come from the options world. So let's pop open this toolkit and see what's inside. First up is something called open interest, or OI for short. All this is really is a head count. It's the total number of options contracts that are still open and active for a specific price. But what that simple number tells you, that's the powerful part. Open interest is basically a map that shows you where the big money, the institutional players, are placing their bets. When you see a huge amount of OI piled up at a certain price, you should pay attention. It's like an invisible wall. These levels act as powerful support or resistance points that you just can't see on a regular price chart. Next on our list is implied volatility, or IV. Honestly, the best way to think about this is as the market's own weather forecast. Now, it won't tell you if it's going to rain or be sunny, meaning it won't predict direction, but it will tell you if there's a huge storm brewing or if it's going to be calm seas ahead. So if you see IV start to spike, it means the market as a whole is getting nervous. They're expecting a big price swing, one way or the other. This is a massive clue. It helps you get ready for a potential breakout or a sudden drop, and it can either confirm or make you question what you're seeing on the price chart. And that brings us to our last metric. And this might just be the most powerful of all. It's the put/call ratio, or PCR. This is a direct snapshot of market sentiment. It's the ultimate tug-of-war between fear and greed, measured by comparing bearish bets, which are puts, to bullish bets, which are calls. So let's use a real number here. Let's say you see a PCR reading of 1.4. What on earth does that mean? Well, it means that for every 10 bullish bets being made, there are 14 bearish bets. The market is just swimming in negativity. Fear is everywhere. And for the average person, that screams, "Sell! Get out now!" But, and this is the big reveal, this is where the pros completely flip the script. They know that when fear is at its absolute peak, when everyone is selling, that's often the exact bottom of the market. So they see this extreme fear not as a red flag, but as a potential green light, a huge contrarian buying opportunity. This little guide here pretty much lays out that whole contrarian mindset. When that PCR gets really high, above 1.4, it's a sign of extreme fear, and that's where you might start looking for a buy. And on the flip side, when it gets super low, below 0.6, it means everyone's gotten way too greedy, which could be a flashing warning sign that it's time to take some profits off the table. Okay, so we've got our 3 tools: open interest, implied volatility, and the put-call ratio. But knowing what a hammer and a saw do is one thing. Actually building a house is something else entirely. So how do all these pieces actually fit together into a real strategy? So here's the key. Pros don't just trade on this options data alone. They're not abandoning the price chart. They start there, looking for a classic setup, but then they use the options data as a confirmation filter. They check OI for those invisible walls. They check the PCR to gauge the mood. They look at IV to see what kind of move is expected, and only when that hidden data gives the all clear, that's when they pull the trigger. So let's make this super practical with a bullish checklist. First, you spot a nice bullish pattern on the price chart. Check. Then you glance at the PCR, and yep, it's over 1.2. That's our high fear contrarian buy signal. Check. You also see a big pile of call OI at a higher price, which gives you a great potential target. And finally, IV is starting to drop, which means the panic is subsiding. When you get all those checks in a row, the odds of a successful trade just went way, way up.
And here's a perfect example from the Nifty index. The price chart was showing bullish pressure building up. Open interest data showed a massive wall of sellers right at 19,700. But the PCR was at 1.3, a really strong contrarian bullish signal. So what did all that mean? It meant that if the buyers could just push through that 19,700 wall, there was a very clear, high probability path to the next level. Now, using this data isn't just about finding aggressive new trades. It unlocks a second, incredibly powerful skill: risk management. This is where we learn how to play defense and protect our portfolio by hedging like a pro. Honestly, the best way to think about hedging is really simple. It's just insurance for your investments. You pay a little bit of money, a premium, to protect yourself from a potentially huge loss. You hope you never have to use it, but man, if the market suddenly turns against you, you'll be so glad you have it.
And there's no single best hedge. The kind of insurance you buy depends entirely on your outlook. If you're just a little nervous, you might use a low-cost strategy. But if you're worried about a really big downturn, you'd probably opt for a more expensive but more robust type of protection. It's all about tailoring the insurance to the specific risk you see on the horizon.
So after going through all of this, what's the one thing you should really walk away with? It's actually not a specific formula or a single strategy. The real takeaway, the big aha moment, is learning to see this hidden dimension. It's understanding that the price chart is just the surface. Underneath it all, there's this incredible world of data about fear, greed, and expectations that's really driving the market. And once you learn to see it, you'll never look at a simple price chart the same way again.
And that leaves us with one final thought. We've just spent this whole explainer uncovering an invisible layer of data in one very specific area. It really makes you wonder, doesn't it? Now that you know this kind of hidden information exists here, what other invisible data might you be missing in other parts of your life? Something to think about. Thanks for joining me.